Welcome everyone to FinTech Australia's podcast, where we focus on the challenges, opportunities and big stories our community faces across the FinTech industry. I'm Katie Wilson, Head of Policy at FinTech Australia, and this special edition of the podcast is dedicated to a topic that has had no shortage of media attention lately: surcharging. You'll hear Andrew Cornell, Capital Brief Associate Editor, moderating a fascinating discussion with two expert guests: Ben Pfisterer, Co-Founder and CEO of FinTech Zeller, and Dan Martin, Senior Vice President and Head of Account Management at Mastercard. Listen as they sharpen the edges of what has become an increasingly fuzzy debate and offer their take on key issues, from excessive surcharging to whether small business really is subsidising big business when it comes to payment costs. And you'll have to listen through to the very end to find out each guest's punt on where the surcharging issue will land. Thanks to our podcast supporting partners, Stone & Chalk and Bank Agency. For more information on our supporting partners, check out our show notes wherever you listen to your podcast. Enjoy.
Well, morning, Ben. Morning, Dan. Thanks very much for joining us for FinTech Australia, and a particularly hot topic, I'm pleased to say, as a journalist, surcharging and reforms to the payment system. My name's Andrew Cornell. I'm the Financial Services Editor at Capital Brief. I've been covering payments for probably 30 years. I have no idea what's going on. So,
welcome to the industry.
I'm very interested to hear the views from the both of you today. And I thought we might just start by getting you to introduce yourselves, briefly your role at Mastercard and Zeller, and then just a sort of quick outline of where you see the issues, and then we can get into the details. So maybe we'll start with Dan.
Well, good morning. Thank you for having me. My name is Dan Martin. I have the privilege of leading at Mastercard here in Australia all of our client and customer relationships across our financial services industry, government, digital partnerships, and importantly, merchants. So based here in Sydney, and a really great opportunity to chat with you both. Clearly a topical item on the agenda for everyone across the payment ecosystem, but really I'd say it's never been a more exciting time to be in payments. We know Aussies are early adopters of tech, and certainly payments is no exception. And we've got a lot of engagement with both our industry partners and the regulators ahead of us.
Well, thanks, Dan, and Ben, over to you.
Hi, Ben Pfisterer. I'm the CEO and co-founder of a company called Zeller. We specialise in sort of modern payments tools and systems, along with sort of a modern take on business banking and financial services for businesses. We've been around for almost 4 years. We service close to 85,000 Australian businesses. At the heart of it, I think this is a really good debate. I think, a debate in an industry like ours in payments is critical because things change. Everyone's affected, from consumers to businesses, so it's healthy to have a debate, and what the RBA is doing is good. My, biggest concern with it is there's a lot of confusion around the topic and a lot of different topics getting dragged into this one debate about surcharging, whether it's good or bad. But I think also the Australian payments landscape has changed dramatically, and so understanding that it's a core piece of infrastructure in our economy now is a critical part of the debate. I think it's been healthy, but hopefully a little bit of clarity comes through as well.
Well, thanks. And Dan, just a sort of minor point that I clear up. So Mastercard obviously works with, tens of thousands of financial institutions around the world, but not directly with merchants. Zeller works with merchants quite directly. So is there a relationship between Mastercard and Zeller?
I can take that one if you want. Yeah, absolutely. We rely heavily on Mastercard, as per other schemes, their rails and their infrastructure to process payments both here and abroad. So it is critical. Obviously, Mastercard's a key part of the Australian industry, so we partner then, and we also issue Mastercard business debit cards and prepaid cards, so we are a partner as well.
A very valued partner. Thank you.
And if we now get to the sort of headline issue, which is surcharging, so I might get you both to run through 25 words or less, or 250 words or less, the substance of your view around surcharging. Because as you say, Ben, there's a lot of issues being conflated here. So we might start with the surcharging. You support surcharging, so can you run through the thinking from the Zeller perspective?
Yeah, I don't know if I can do it in 25 words. I think I've used up all my words then. For us, I think we service Australian businesses and they're our customers and our number one priority, our reason for being. And so we hear it pretty loud and clear these days that since the RBA mandated that businesses have the opportunity to surcharge, obviously that appetite has built up over time and now becoming quite a prevalent thing and why it's such a topic of debate. But yeah, we hear pretty clearly from merchants that they value the ability to surcharge, so we support their view. Taking a step back from sort of like more of a company view, I think there are pros and cons of both things, but understanding that it is a mechanism put in place and encouraged by the Reserve Bank, albeit a few years ago now. So to see merchants leveraging that is correct and good to see. I guess the bigger concern amongst all the different topics is that there's a lot of bad practices going on at the moment, particularly in the space of excessive surcharging, and us as an industry playing a role to make sure we minimise excessive surcharging as payment service providers like we do. And I think there's a lot of bit that can be cleaned up on that debate to make sure the excessive element of it is taken out and just the true cost of acceptance is focused in the surcharge. And then I think, whilst it won't appease everyone who doesn't like surcharging, I think it'll go a long way to making the debate a lot cleaner and a lot more pragmatic.
And the ACCC's just been given the Australian Competition and Consumer Commission. Ever since the ban on surcharging was overturned in 2003 or 4, the ACCC has been the regulator in charge of making sure there was no abuse. And they've probably done a dozen actions or something over that period. But the view is they've largely been on the sidelines. Are you expecting the ACCC to be a lot more prominent now that they have this extra funding and, as you say, Ben, it's top of mind?
I'd like to think so. I think they can reach out to industry to get some help there as well. It's obviously, as you touched on at the start, in the payments industry is very confusing. I think there are some really easy, quick wins that the ACCC could get. I think it's not hard to actually look at payment service providers' websites and see what they're charging and then have a look about whether that's including things that shouldn't be surcharged, like loyalty points and airline points and what have you. And sort of cut back on that and sort of at least talk to those providers to see their position on it. I think that's an easy one. And the other sort of few things that I could see is that something that we've done since we've launched, we don't allow our merchants technically to surcharge more than we charge them. So it's a technical limitation. They can't do it. I think that would be a great step forward for every payment service provider in Australia to do, and for some reason they don't do that. So that allows surcharging. You can go to banks' websites and they'll show you how to excessively surcharge, some of which even nominate 10% as a surcharge you can put on. So that's perplexing for me too. The other thing that I'd like to see is the ability to show the full amount of the transaction up front so the consumer can have that choice. So they know exactly what they're going to pay. They don't get proverbial surcharge or bill shock when they look later a surcharge was applied. Another thing Zeller does, you'll see in the biggest font will be the full amount charged with the surcharge. So I think those two things would be fantastic and easily quick wins that the ACCC could do. So I assume they are going to take a more proactive step. They do have it's a history of sort of going after some bigger targets to make more of an impact and statement, which makes sense. But I think it's an easy one. There's so much excessive surcharging going on that we could cut back a lot of that.
And Dan, Mastercard has always opposed surcharging, and in fact, until that initial wave of RBA reforms, coming up to more than 2 decades ago, Mastercard banned surcharging. That was overturned despite some legal challenges from Visa and Mastercard. So, is that still an organisation-wide position that surcharging should be banned? And can you run through why it should be banned?
Yeah, I mean, we are absolutely aligned in terms of transparency and the compliance to local Australian regulatory requirements, but globally, you're right. We have the view that surcharging doesn't generate a great consumer experience. However, we really do balance that with a view that that's not to say that merchants shouldn't be able to recoup the cost of payments as an input cost and ultimately the cost in which a consumer pays. But we believe that the removal of a surcharge enables a increased ability for merchants to drive competition, to shop around for the best, not only price but value-driven partnership with their payment service provider, and ultimately, Mastercard and the network doesn't set the price that the merchant pays, but we do have a view that the surcharging flow-through doesn't generate a great consumer experience.
Dan, so implicit in what we're talking about, and I accept that this is network economics, which are particularly complicated, but at the moment, the RBA would like to see more competition in the system to drive down the cost and improve the value. So is your argument at the moment, because a merchant can surcharge for whatever cost it is, whether it's 1.5, 1.75, 2.5, then there's no real impetus for them to shop around for the best deal for them on the merchant acquiring side, that they can just surcharge whatever it is?
Yeah, absolutely. I mean, the emergence of the surcharging rule, which predates the way that Aussie consumers pay, in 2025 and will continue to pay moving forward, has dynamically changed and made way for a lot of new entrants into the market. And it's clear that the way in which merchants want to simplify their value propositions to engage and hopefully drive more consumer payments to their businesses, both large and small, has meant that the emergence of these new models have existed, and it's one that the regulatory framework has yet to catch up and consider. But with that, the ability for all payment costs to be wrapped up in a surcharge has limited, in our view, the competitive nature of merchants looking for alternatives to ultimately drive down the cost. So we think that is one of the elements in which we believe that the removal of surcharge, both across debit and credit, should be considered.
It strikes me, Ben, that you might not agree with that perspective.
I partially agree with it. I disagree with the point where there's not competition. I think most merchants, the majority of merchants, would say they don't want to pass on an excessive surcharge and they want to minimise that surcharge amount to avoid any uncomfortable conversation, whilst the debate and the concept of a surcharge is quite new for consumers and merchants alike. I think I agree with Dan's point in terms of once you start incentivising particular merchants to excessively surcharge, like if we would charge 1.4 and allow them to surcharge 2% and pocket the difference, that's not right. And that does incentivise certain merchants to obviously take the more lucrative avenue of an excessive surcharging product, which I don't think the majority of businesses do at all. They want to make sure their customers are happy at that point of transaction, but some do. And then again, with points or benefits above and beyond, if you're incentivising the merchant to do it, does take away a bit of that competitive edge. But if that's taken out, as I said, I think that's actually quite a relatively easy thing to do, put those stops in place, then you do have actually a competitive environment where people can look to the best provider, the best service. It's not a commoditized product anymore like it used to be, and make sure they don't excessively surcharge, and so they can compare and contrast and choose the provider who's right for them.
And if surcharging was banned, would that change the dynamic with the merchant that you're seeing?
This is the big confusing part as well, is like, as consumers, I assume the majority of consumers don't like surcharge and understand why, the perception of it, they're paying extra when they shouldn't. But literally, if it was banned overnight, you would see a across-the-board increase in prices. It just would, because it is a legitimate cost to a business, which they, like any other cost, have the right to recoup in their cost of sale. So whilst we'd feel good as consumers, suddenly there'd be no additional surcharge, the prices would go up. And the downside to that is suddenly you'd have a completely opaque payments industry. No idea who's charging what, no transparency whatsoever. So, and that is where we've come from, ironically. So if we're pushing back to get rid of that, I kind of see the benefit to a degree. But we have to be realistic about what the outcome would be. And would we as consumers and merchants be happy suddenly not knowing what payments are? Consumers don't care, like they just want to pay the amount. But as the payments industry and merchants, suddenly we wouldn't know what they're being charged. And that opaque nature, I think, is probably a regressive step back.
What do you think of that, Dan?
Respectfully, I think the ability for payments to form part of the overall input cost that a business operates has parallels to other input costs that merchants ultimately grapple with in the running of their business. It forces, I think, merchants to take a look at the input cost to ultimately drive action to get a better deal, which we're fully supportive of. So I would probably say the counter to Ben on that, I do think that the transparency of costs at a merchant level will drive increased competition.
You touch on really, and this is an issue that sort of lies underneath everything we've been talking about. I mean, surcharging has been around for a lot longer than digital. Well, maybe not longer, but airlines have long surcharged, hotels have surcharged, cabs surcharged. I think when cab charge came in 15% or something, but it is an issue that has very much come to the fore. So the interesting question is, why is a payment a different category of cost to a business? So we don't surcharge for more refrigeration in summer, or we don't surcharge for someone who elects to not have milk in their coffee, or all these sort of various minor input costs. We don't. But then on a higher level, we don't surcharge unless it's a weekend penalty on labour. We don't surcharge on utility bills. So why would we surcharge on this extra cost of doing business, which is accepting a payment?
I think it's a good question. It gets debated a bit. I think, to your point, surcharges in different forms, whether it's public holiday, weekend, loading, whatever, is actually becoming a common thing. So you are seeing more of it beyond payments. But there's two distinct differences or factors that weigh into this. One, it is a mechanism that was promoted and encouraged by the industry and the Reserve Bank of Australia to be used by merchants. So it was a formal thing that was said they're allowed to do it. It wasn't like a nefarious scheme by businesses that suddenly started whacking on this cost. It was a formal structure that was embraced. So that's one part of it. And the second part of it is there is a little bit more relevancy in a surcharge on a payment at the point of payment, as opposed to paying for your services or your air conditioning or your insurance, because it's not related to the direct interaction. So it's slightly more relevant at that point of sale. But I get it is an input to the business, which could be argued somewhat similar to a lot of the other inputs like staff costs and rent, etc. But it is slightly more relevant to that interaction than that.
And Dan, what's your view on, is it just a normal cost of doing business, or is there something different about the cost of accepting a payment?
Look, I think it is a standard input cost, because ultimately the way in which consumers are paying has dramatically evolved. The rules that we're contemplating at the moment predate the use of smartphones and the digitisation of payments, which now make up the majority of payments we see. It goes to the point around some of the perceptions across the industry around some of the education that's incumbent on all of us to do, and one of those is that payments are free, but also that the topic of surcharging is rife. We know there's a over-index in certain verticals, merchant verticals, in which surcharging has become the norm, and that's made way for a new ecosystem of participants and technology offering available. But I come back to the point around payments is an input cost, which we deserve to offer merchants more competition, ultimately to get the best possible deal.
And something I've sort of noticed and I've struggled with when looking at this debate, there doesn't seem, and you touch there on some verticals where it's more prevalent, but it's difficult to see from the outside. Like, we have some major merchants, Coles and Woolworths obviously spring to mind, who just don't surcharge. We have other major merchants like Qantas who extremely aggressive surcharges across a number of levels. Some small businesses don't surcharge, some do. Even in the sort of famous example of a farmer's market, where everyone's got a little device, whether it's a Zeller device or something else, not everyone chooses to surcharge. So are you seeing particular trends, Dan, across these verticals, or is it a bit random?
No, we can certainly see a over-index in the food and beverage space, and there's a lot of payment service providers that have generated their business models out of serving that particular merchant vertical. Whilst you make the point in terms of large everyday retailers are not surcharging, but there's pockets of very large national brands that do.
I mean, it's interesting because early on in this debate, I spoke with some of the service unions, and what they notice is where a restaurant surcharges, their staff get fewer tips, and I think the argument, as a consumer, you think, well, why would I tip when I'm already being surcharged? of course, the surcharge goes to the owner of the business. The tip goes hopefully to the staff in the business. The tip is often 10 or 15%. The surcharge is only 1.5%, but it has a sort of disproportionate impact on the tips that the service personnel are getting. So.
Yeah, I think all businesses, as to your point, have to make a choice whether it's right for them and whether they want to make sure they incentivize their customers to tip, or they want to make sure that their cost is the lowest as it always can be, or they just don't like surcharging. That's their choice. While the mechanism's there, they have that choice. But if it was to disappear, it wouldn't materially impact the business. I think it would just net out similar, just the cost would be absorbed.
I mean, and Dan touched on this, there is a lot of competition from new players, and in fact the data is difficult to track right down, but it seems that about 25% of the merchant acquiring market is now non-banks and new players and fintechs, compared with even 10 or 15 years ago when the major banks in Australia had more than 90% of the acquiring market. Zeller's one of those, one of the new players. You've got a model that is not exactly unique, but it's certainly a lot different to what existed in the past. If surcharging was banned, would you have to change your business model, tweak the business model?
Not at all. It makes literally no difference to us. We just switch off the capability within the technology, so surcharging can't happen. So, because I said, if we were profiteering or we were putting points in there or extra benefits on top of it, or we'd predicated our business model on merchants being able to take a margin on top, then there would be a completely different conversation. But if it gets switched off, it gets switched off. We move on. It wouldn't make a material difference to our business at all.
Mm. And a lot of this conversation we're having, it gets back to the transparency. How do you know what is going into the surcharge? What are the real costs? What are costs that are not so legitimate in there? Dan, is that something that Mastercard has a clear view of? Not necessarily making public, but do you see what's going into these surcharges?
No, not currently. I mean, as a network, we set the price to our direct partners, so our payment service providers, acquirers, and the like. Becomes their responsibility as they monetize the value in which they deliver to merchants, which is not just a component of how we support the payment ecosystem, but clearly the value that is delivered to both small and large merchants. I guess the role that we play, and one that we're quite passionate about, is the advancement of value to small businesses. Back last year, we enhanced the existing small business program that we operate, which delivers a lower cost of acceptance through preferential interchange rates for small business. So we recently enhanced that program to replicate the classification of the Australian Taxation Office. So the turnover of a small business, we can pass through a enhanced interchange rate, which we know drives down the overall cost for small businesses, and we look to our industry partners, our acquirers and payment service providers to make that available.
I'm sure that's a very welcome initiative for the smaller businesses that are able to take advantage of it, because the disparity between small, medium and large businesses in what they are paying for payments is something that's a really hot topic. There's some very sort of active organisations and industry bodies that are arguing the case that small business is cross-subsidising larger business. They're getting a very good hearing in Canberra. Obviously, the small business lobby in Canberra is very powerful. So I suppose the interesting question for a lot of us who are standing outside is small business cross-subsidising big business, or are we talking really here about economies of scale and the investment that big business is making? And Dan, I might ask you first and then Ben.
So we've done a range of research, some independent research globally, actually across 14 global markets, and it was focused on advanced digitally native markets and really looked at the cost of payments across the industry, but most importantly looked at both direct and indirect costs that exist, including some of the back office costs. And what we found that in the case of Australia was the direct costs, some of the most are the lowest that we've seen, whereas the indirect costs, so fraud and miskeying of payments, are actually part of the largest component. So a really simple piece that the data suggests in terms of ways in which merchants could save money, around 30% of their annual payment costs, is simply by switching to an integrated terminal that can reduce the risk of miskeying. So there's some really simple steps in which merchants can take that we've found through that data as just one example to support the competitiveness of payment costs.
And Ben, do you have a perspective on that? And I think particularly around the relative costs of payments and what are, as Dan said, administrative costs. Cost of cash is obviously a lot higher than people assume.
Yeah, I think the cost of acceptance is a really complicated space and it always gets confused and the debate gets very murky. So I think what you're hearing often with why big businesses like Coles and Woolworths and these massive merchants pay less, often people what they're talking about is interchange rates. And so they have obviously strategic merchant rates. And if I take a step back and don't put my personal view into it, I think big businesses get better rates for scale in every industry. It's a common practice. I wouldn't be able to find an industry where they don't get that. So it's not a payment specific thing. But going into that, if you have a look at taking out interchange is often a minority line item. It's sometimes a majority depending on the card type or the value of it. But it's just an input into a myriad of different charges in a modern payment stack. It's so complicated from onboarding, KYC, AML, facial recognition technology to make sure we can do selfies to onboard, all the way through to risk checking, getting them terminals shipped out, getting them set up on apps, making sure that there's fraud detection tools in place, there's 24/7 customer support. They have access to fast settlements. They have the most modern tech stack, et cetera, et cetera. There's so much that goes into that. And I look at the small versus big and a couple of things. Like one is interchange, which is only one cost input. Is that fair between small and big? And that, I think, are probably a relatively good debate to have. But I also know firsthand that, unfortunately, whilst we are so proud to service so many small businesses, it is actually more expensive to service a small business because you have to onboard, you have to do all these different things and support. And when you talk about Coles and what have you, often the amount that they report that they pay doesn't include all the back office charges and all the different things that they do. They run their own switches, they have their own support networks, they pay their terminal manufacturers, and there's a whole lot of costs which the reported numbers often don't include. So I'm definitely not advocating for any more cuts to big businesses. As I said, we service small business, so we'd love to see the prices come down. But it is a little bit of an apples and oranges comparison when you do that, if you're talking anything other than interchange. Because it is the fact that Australian businesses now can, of any size, if you've just set up and you want to sell once a month at a market stall and you want to make maybe $100 or $1,000 is a good business for you, the type of payment technology you get access to today is phenomenal, absolutely phenomenal. So there is good value there. That said, if you start scaling as a business, those costs start scaling as well. So to making sure that the costs can come down with their scale as well is critical. And I think the competition, to your point, that we've seen come into the market in the last 10 years has been incredible for that. I cannot think of another industry that over the last decade where, I guess, cumulative price increases over the last few years, inflation is exceeding 30%. But payment costs for businesses have come down. That is phenomenal. There is no other market I can think of or product or service out there where that's happened. So they not only come down for businesses to accept payments due to that competition, but what they're getting for that dollar spent on payments is absolutely phenomenal. The efficiencies they drive through their business, the way they can handle it, the less staff costs from the breakage, et cetera, et cetera. So the value for money is fantastic. The costs have come down. So I think there's a lot of good coming out of that. But there is still, back on your question, there is a debate about whether some of the costs going into payment acceptance is skewed towards big or small. So that's a reasonable debate.
I mean, you obviously talk to a huge number of merchants and not just the ones who ultimately become your clients. Do they appreciate that argument? Do you win them over when you say, well, look at how much better value electronic digital payments are today compared with what you were doing 10 or 15, 20 years ago?
yes and no. So they're passionate about their product, their service, their industry, whatever that is. They're not passionate about payments. So we have to sort of take a step back as payments people and expect them to be too passionate about it. But when you sit down and sort of have a decent conversation with someone who's seen that evolution, been part of it, 100%. Like the fact that they can get instant reconciliation of their money, there's no counting losses, it's straight into their bank account of choice. Those efficiencies are phenomenal. And it not only improves their processes, but the interaction between a buyer and seller is improved. So that frictionless experience is made a lot better. So no, that they definitely do. And I think that competition, everyone talks about competition of, whether what the rate is and that. It's becoming clearer and clearer that businesses are understanding that payments are no longer commoditized. They're no longer like, well, there's 4 terminals from 4 big banks and they're pretty much the same. They sit on there. They may or may not work. They may or may not have an outage. They don't do anything for me. They just route a transaction. Those days are gone. The sort of services you can get with payments now are phenomenal, and businesses are increasingly, it's a journey for some people who are just getting used to it, but absolutely we hear it loud and clear that businesses are coming to Zeller, and I guess other providers like us, coming to Zeller because of the products we offer and making sure that they get better services, better reliability, and more innovation to make sure their payment is safely routed. So yeah, we hear it loud and clear. They see it as a non-commoditized product.
And Dan, you've got obviously a different perspective as a global infrastructure organisation. Nevertheless, it seems to me that you probably have a very interesting perspective on that too.
So what Ben's just touched on in terms of the overall value levers that merchants rightfully demand from the payments industry, I couldn't agree more. The advancement of technology, the investment that we collectively have made and need to continue to make to drive efficiencies in the way in which payments are serviced, but also consumers interact with their merchants of choice. One of the things from a global Mastercard investment that we have made is, over the last 8 years, over $10 billion has been invested into enhancing and improving the fraud and security components. And we do that because it's important in terms of the overall health of the ecosystem, the protection of consumers and for merchants. But importantly, we make that available to our key market partners, and that's made available to all Australian Mastercard acquirers and payment service providers, which goes to the point in terms of, as technology continues to evolve, the rise of fraud and security breaches we need to be laser focused on, and that's where you continue to see investment into the network that happens at a global level, but more importantly, delivered locally to our key partners.
And do you think it's appreciated that the security costs, the privacy costs, that they're legitimate costs of doing business? Because again, and I think this is a perspective that's not just Australian, but the perspective that you hear in Australia is that's something different, yet there is a cost, presumably, to investing in all these anti-fraud measures and security measures.
I mean, the primary principle around payments in the ecosystem are not free, but I think there's equally an increasing transparency of the impact of fraud in the payment ecosystem, and then equally the role that not only networks like Mastercard have, but equally our payment service providers, acquirers, and ultimately merchants have to help protect consumers. In the last 12 months, we've stopped a number of fraud and security attacks on the payment ecosystem that happened, and that's led us to focus on, how are we going to improve the consumer and merchant experience and remove those bad actors from the ecosystem. Just a few months ago, earlier in January, we announced our roadmap for the next 5 years, and one of the things we contemplate is the enhancement of the network, the Mastercard network, the focus on safety and security. And what's come from that is our announcement to work with the industry, work with our issuing partners actually to remove that 16-digit card number from physical cards as we move to a more digital-focused and tokenized payment ecosystem. So there's lots happening around the industry to make sure that we're protecting merchants and ultimately to keep consumers safe.
And Ben, as we start to sort of circle around a bit, again, you talk to lots and lots of merchants. When you start the conversation, what issues do they bring up?
There's a wide range, absolutely. So it depends who their current provider is. If it's an old school incumbent bank, it's frustration with the speed, the reliability, outages, costs, complication of cost structures, limitation of innovation, you name it. It can be down as simple as we think the terminals that Zeller provided beautiful, through to cost, through to functionality, reliability, trust, you name it. It can be a range of different options. And merchants do vary dramatically on their prerequisites, what they're looking from a provider.
And that brings us to another sensitive touch point, which is blended pricing. Now, there's been commentary from the regulators on blended pricing. The RBA is not theoretically a fan because it wants to see clear price signals. Equally, it seems that a lot of merchants like blended pricing because it removes layers of complexity. So what's your perspective on blended pricing?
It won't come as any surprise that I'm very supportive of blended pricing. And that's not just due to the direct obvious bias of Zeller offering blended pricing, but you go back 10 years ago, everything was unblended. The ability to understand pricing was impossible, absolutely impossible. And unfortunately, incumbent banks and the providers at the time took advantage of that opaqueness and complexity. So merchants had no idea what they were paying. And when we used to have early conversations with merchants and try to break down their statement, if we could understand it, they would be shocked at how much they're paying. So the other big confusion about blended pricing is really, simply put, an amalgamation of all the costs that you take to process a payment. Not just interchange, as some people seem to focus on. Interchange plus all those costs I mentioned, losses, chargebacks, support, et cetera, all into one rate. So merchants don't have to care about the complexity of payments. They want to sell products, sell services to their customers and charge a reasonable price. So taking that complexity out, putting in a blended rate, it is nothing to do with gouging. It's nothing to do any of those things some of these more misinformed pundits in the industry like to talk about. We operate an incredibly low margin business, as most payment providers do, to provide as low cost so we compete on price amongst other things. The ability for a merchant to not care about what card is being pulled out, no offense, Mastercard, what card is being pulled out at that point of sale is critical, and it's the most common thing from a merchant. They say, we're not here to push a card holder to, I don't know, put that card back, pull this one out, this one's better for me, or I don't know what that one is. Or actually, I have to think about the average transaction value to work out what the interchange table is to then put the additional card. It's nonsensical. We were all about unblended. 10 years ago, we started moving away from that. Merchants absolutely love it. It also gives them the ability to price compare. So you can't hide. If you're offering a blended rate, you can, as a merchant, you can simply look at one rate and go, that's too high, I want a lower rate. Look around, look at the best provider, if cost is your decision factor. So blended rate is a fantastic thing. It's also helped highlight that prices have continued to come down. If unblended rate, it's just absolutely opaque about what they're charging and what it costs. The other confusing thing in the industry is that you can get blended or unblended any day. You can get it from different payment service providers. Blended was never thrust upon merchants. There was no incumbent bank holding market share that said you must accept blended. It came through with new entrants like Zeller, like Square, that said, hey, that's way too complicated. Let us reduce the prices as much as we can. Let us put efficiencies through our businesses to give you the lowest cost so you understand exactly what you're paying as a business. Merchants love it. They have the choice. It shows that prices are coming down. It's a positive for the industry. Any move back to unblended rate would be a completely backward step to an era we've finally just dragged ourselves out of. So it's probably the one area I get most disappointed about, the complete narrative misinformation about the cost of acceptance versus a blended rate. It's completely wrong. It is an amalgamation of costs, and it's showing it's coming down, which is a positive for merchants.
And if a merchant did want to know the components of the blend, can they find out?
Not all the way down to how much do we charge for chargebacks and our fraud losses and our onboarding and our terminal fees and our AWS services and our fraud protection systems and our customer support. I don't think they care about that. What people talk about, again, is simply talking about interchange, which is but a one-line item on that long list of costs that have to, a legitimate payment cost to process a payment. I can't imagine a merchant ever saying break that down, because that's literally the era we come from convoluted, confused statements which made no sense. I could never even understand them. I was in the industry for decades. So I haven't come across a merchant who says, I want to understand every line item that goes into your costing. I've never heard of that.
Dan, what's the Mastercard view on blended rates?
Look, I think to Ben's point, we know that merchants like simplicity. Equally, every merchant has a different need, so we think it's really important and valuable for merchants to understand how their payments are processed and ultimately empower merchants to make the decision that's right for their business, their payments needs. And so that applies equally to the commercial, the payment cost model, in the same way that they decide around the types of technology and functionality in which will be used to power their business. So we recognise that merchants like simplicity, but we also know that every merchant has a different need. So to understand their need to understand how their payments is processed, we think is key.
Well, look, it's been a particularly fascinating discussion. I wonder if we can sort of circle back again to where we began and look at what's happening at the moment. We have the RBA review of payments and surcharging. We have the ACCC taking a greater interest. There will be some kind of legislative change, maybe sort of a change to the regulatory infrastructure coming up. But I think underlying it, and certainly from the perspective of the RBA, their view is they want transparency. They want costs, to keep coming down. So I'm just interested in both of your view. And again, I know this is going to be a shocking simplification, but what are the 1, 2 or 3 things that could be done to make the system more transparent, to increase competition in the system, and yet match that sort of RBA view of it should be a user pays, a cost per what you're getting, and not something that doesn't have any clear price signals. And maybe we start with Ben.
Yeah, I think some of the stuff we've had a good discussion about today, just enforce more strongly, I guess, the excessive surcharging principles. Make sure that when people tap their card or phone on a terminal, they know exactly what they're going to pay. It's not confusing with the surcharge added later. Make sure that's abundantly clear. Let's just get out there and write please explain letters to all those providers which enable excessive surcharging. It's really simple, as we found out, to turn off the ability to excessively surcharge. Let's get that done. Let's narrow the debate down to whether surcharging is something of a bygone era or something in the future. That's critical. Another part of it is I think we have to be really careful as an industry, because there are two polar opposite debates. What the next rising narrative now is today is everyone's starting to realise, with the disappearance of cash, is that the electronic payments infrastructure is core national and international infrastructure. The reliability, the stability, the fallbacks, the outage management, all that is absolutely critical. What we do not want to do as an industry is force participants into clunky pricing methodologies or force them into regressive steps of how businesses used to run payments. Make sure we're allowing competition to do exactly that, to compete, to force down prices by the economies of scale and them to drive a more efficient business. But be very, very careful how far we try to artificially force down costs, because that will kill off innovation. We have one of the most innovative payment markets in the world where everyone benefits. Let's not kill that off. And 2, let's make sure that we're actually supporting and promoting the infrastructure players like Mastercard, etc., the payment service providers like Zeller, to actually invest in better tools to fight fraud and to fight any sort of crime that's coming in the ecosystem, because it is growing. It is becoming harder and harder. Payments are moving faster and faster. You drive out costs, you'll drive out innovation, and then you'll restrict the ability for businesses to make sure that it's a secure piece of infrastructure to use. So I'm not the short answer you're after, but I think we have to be careful on that second one. I think it's really critical debate that we invest in our infrastructure and our industry at the same time.
Well, thanks, Ben. And Dan, over to you.
Look, Andrew, you've probably read, no doubt, the range of industry responses to the RBA's consultation paper. And I think what I'd reflect on is there's no consensus on a lot of the topics raised. It's a big job that the RBA has on their hands. I think at the end of the day, increased transparency, supporting businesses across the payment ecosystem, making sure that we find balance, especially for emerging fintechs in the Australian context in terms of the role that some of these input costs play, we think is super important. But also finding the balance between some of the industry positions, across how surcharging is applied and to what types of consumer products in which surcharging, from our perspective, should be removed, and equally where it doesn't doesn't apply in terms of unregulated products. We'll continue as a global technology network and partner to make significant investments, to Ben's point around protecting and removing fraud and increasing security for the payment participants, because our world has changed. The rules in which we're contemplating, set by some of our regulatory industry colleagues, are ripe for review and for commentary from the industry. So we're really privileged to be part of that ecosystem and to make sure that we share a perspective ultimately that will see the empowerment and growth of our economy and for merchants of all sizes.
If I could just add a couple of points there, because you've raised some good points. But if you come back to, we don't celebrate our industry much. We like to criticise it for some reason. We're a very negative industry. But if you look at the 2 points you made there of competition and transparency, we have never had a better industry. We have so much competition happening, finally. Like 5-10 years ago, there was nothing. There was a couple of people trying to chip away at the banks. Now we have competition in all different shapes and sizes. It's fantastic for different businesses. So we've got competition. Transparency, thanks to blended rates, you can go to any provider's website and see exactly how much they're charging. It is not a hard thing. You can do it in 5 minutes. You can collect all the different pricing. So we have actually achieved those two things. There's a lot we can still improve, a lot we can go forward. But those two principles, I agree, we have to pause for a minute and say, we're actually at a pretty good spot. Prices are coming down. They're very transparent. There's a lot of competition finally in the industry. Let's push it forward in a positive direction, not dampening it again and go backward to any things that we've just come back from. So,
well, look, thanks both for your time. It's been really fascinating, but I'm not going to let you go without making a hard call. So answer A, RBA will ban surcharging. Answer B, they'll partially ban it, maybe just on debit. Answer C, they'll leave things as they are. Dan, A, B or C?
Hard question, Andrew. For me, I think it's A, finding a ubiquitous approach for credit and debit and surcharging to be banned. I think A.
Thanks, Dan. Ben?
First, before I answer, B, getting rid of surcharging on debit is ridiculous because, as I said, there are so many different costs that go into processing a payment, not just interchange. So why you'd be able to not surcharge one and not the other makes absolutely no sense to me. Also, it's down to the average transaction value. In some cases, debit is more expensive. So I don't know how you explain that to merchants and payment service providers. Oh, just because it's one line item, we're going to just ban one thing. And customers, you got to think twice about what card you pull out. And merchants, you got to worry about what cards. That would just be ridiculous. We've been there. It doesn't work. Let's not look at that again. I'm going to cop out and say 1A, focus on getting rid of excessive surcharging. It's clear that it shouldn't be there. We need to, as an industry, all do more to get rid of it. Do that, and then have a clear debate on whether surcharging is something we want to stay or get rid of. But the first step has to be 1A, get rid of excessive surcharging.
Well, thank you both for a really frank discussion. I've been speaking with Ben Pfisterer from Zeller and Dan Martin from Mastercard in the first of our FinTech Australia podcast series. I've really enjoyed it. I hope everyone out there listening has got some understanding of what is an incredibly complex issue, but one that's sort of fundamental to all of us. So thanks both for your time.
Thanks, folks.
Thanks, Andrew.